it seems pretty obvious to me that on a long enough time horizon, all stablecoins basically just move to Lightning as a settlement network, or to some extent like a value transfer network.
Hello, I am Cody Ellingham, and this is the Transformation of Value, a place for asking questions about freedom, money, and creativity. My guest today is Alan Farrington, who co-wrote Bitcoin is Venice and Only the Strong Survive, and is a co-founder of Axiom, a Bitcoin-focused venture firm. Alan, welcome back to the show.
Yeah, thanks so much. Thanks for having me back.
You wrote an article on Nosta last month about the future of stablecoins, and also back in January we saw announcements from Tether and Lightning Labs about USDT coming to the Lightning Network via taproot assets. Can you run me through at a high level where your thinking is at with things and sort of what your what this article is about?
How long do you want me to talk for? I mean, this article is like I tend to think in terms
I just
of
reread it,
word
yeah.
page count.
Yeah.
It's like 6 pages in Word.
Yeah.
I actual word count, I'm not sure. Okay, super high level. Let's see. I'll tell you what, yeah, I'll just give you like the highlights with no actual explanation, and then we can get into whichever part of you think is most interesting. So, stablecoins are clearly a thing. As annoying as Bitcoiners typically find that, I think in particular, not so much that they have a problem with people using dollars. I guess you could go that far out the ideological spectrum and say, no, Bitcoin should just replace absolutely everything. Probably in a long enough time horizon, I would agree with is likely to happen. But I think the real reason Bitcoiners are kind of peeved by this is that it is a use case of crypto. It's actually probably the only real use case of crypto that isn't kind of circular or scammy or doesn't really amount to anything more than gambling. So that's kind of the starting point. Stablecoins are real. Broader TradFi, or maybe more like fintech, is kind of catching on to this. And I think the thing that Bitcoiners tend to miss is, yes, stablecoins are stupid from kind of an engineering perspective. Like you basically don't, I'm sure we'll get into this, you don't need a blockchain for them. However, I think they miss that actually regular fiat is even dumber than stablecoins, and so this is where the kind of product market fit is coming in. That people who are oblivious to all of this, right, who have no notion of these like intra crypto culture wars, for a whole bunch of use cases, are just realizing the stablecoins are better. So that probably happened a couple of years ago, but now more serious, credible fintech is catching on to this and is making all kinds of announcements about, at least experimenting with stable coins. And so that then gets into the meat of my argument, which is that this won't work in crypto for basically reasons that I think all Bitcoiners do know. I think the weird difference is that the kind of technical and economic contradictions as to why it is dumb in crypto, you don't actually see these. Like, they don't impede the performance, like the user experience, until they're used at a way bigger scale than they are now. So they're currently in this weird, what would you call it, like transitional phase, let's say, where they're small enough to actually work, which is what's attracting attention. But as soon as they get more popular, they'll break. There's a whole bunch to go into there. Obviously, I'm kind of skating over any real explanation of why that's true. But the exciting thing, I think, is exactly as you mentioned in the introduction, taproot assets getting closer and closer to being a thing, basically being real rather than just an idea that people have been talking about for a long time. And for a host of, I guess, similarly technical and economic reasons, I think they will work at scale. I think, if anything, they have the inverse problem. They're the most difficult to use when the fewest people are using them. But the more people use them, the easier it's going to get for everybody to use them. It seems pretty obvious to me that on a long enough time horizon, all stablecoins basically just move to Lightning. I just use that as a shorthand. I don't think it even needs to be like taproot assets specifically. We can get into some of the nuances there too. But they all move into using Lightning as a settlement network, or to some extent like a value transfer network. And then the thing I ended on is that this is way, way, way more out there and speculative, but if we do get to that point, so say, I don't know, 10, 20 years, however long it takes, going right back to the whole, well, you don't actually need a blockchain for this, you probably don't even really need taproot assets at that point either. You can actually just swap it out for eCash. And so that's my grand stablecoin thesis, is that in 50 years or whatever, actually it's probably like the last step before we just use Bitcoin anyway, which is kind of the exciting point too, that transition then becomes a lot easier as well, right? Because currently, if you're thinking, I mean, probably every Bitcoiner has some experience of this, you have the starting point of most of your life and most of your day-to-day expenses in fiat, and Bitcoin kind of takes a lot of effort. Like it's a completely segregated monetary system that you have to opt into, which is, great for philosophical reasons, but in terms of the practicality of it, it will be a lot easier for people to change if the dollars or pounds or whatever they're using are just stable coins on Lightning, because it's no longer like a almost an engineering hassle for you. It's basically just a preference. It's like you flick a switch. You're like, I actually would rather have real Bitcoin now. So yes, I guess penultimate stage of all of this development, I think, is probably stable coins are all eCash and they all route over Lightning. So that's my thesis.
Yeah. Okay. Well, there's a bit there. So I think zooming out a little bit before we get into some of your technical points, just in conversation, I think there's kind of I don't know if it's a Trojan horse or there's something going on where I think the reality is, I know the reality is stablecoins are being used quite extensively in places that have shit banking systems.
Yeah.
Much more than Bitcoin. And I think we sort of put on the masquerade, and I think we still try and champion Bitcoin in those situations. But at the same time, I think we are cognizant that there is a reality and there is a product market fit there. And so I think that's sort of playing a bit of the game there, where I think, of course, I'm always going to push for Bitcoin, but stablecoins are making a real inroads in a lot of places. And I've had these conversations with people. And so
yeah, I just think they're completely different, right? This was kind of a very helpful realization for me, having just been disgruntled about this for years and years, that I don't really think they compete in any meaningful way. I think they're entirely different. Like, I basically don't think stablecoins are crypto. And that's probably the best way of putting it. They're sort of an accidental byproduct of crypto, but they don't really have anything to do with, to get super cringy for a bit, like blockchain technology, right? I mentioned that extensively in the introduction, right? That you don't actually need blockchain for this, and it's better if you don't have a blockchain, actually.
Yeah.
It's all the crypto garbage that is directly competing with Bitcoin. I don't think anybody really makes a claim that like stablecoins are the new Bitcoin. I've never heard that meme. I think stablecoins are just fintech. They're just payment rails that are worse than Bitcoin, but better than fiat. But they use the same denomination as fiat, so everybody's expenses and liabilities are all in that denomination. So for them, it is an improvement.
Yeah, well, they're kind of this kind of grey Formica IKEA kind of thing, right? It just, it kind of works, but it's also like the dollar hegemony, which you talk about, ideologically, yes, in Zimbabwe and in Argentina, like what does this mean? But I think this is an interesting thing, though, just again at that high level, that you've got this project that is taking place where it is a dollarization project. And I think that's something to keep an eye on as we kind of go through this conversation, because it's the stablecoin is superior to the local fiat in those situations, and so that's kind of creating a geopolitical dynamic. But also at the same time, it's creating its own. It's on the US side, it's creating a situation where you've got Tether, this small organization that's handling all of this stuff, and it's sort of outsourced. The US government has kind of outsourced this project to this one company.
The dollarization project. Stirring up demand for treasuries globally project.
And something that was interesting, you mentioned this network effect and the first to market, and this has sort of come through with 80% of stablecoins also are USDT Tether, followed by USDC and then some others, but basically it is Tether and that's it. And I'm just wondering, I mean, maybe we can start there, sort of talking about that network effect, which you do sort of outline quite a lot, but basically there's one company and it's doing everything, and maybe there's some challenges with that.
Yeah, so this is worth explaining quite a lot of detail. So this is the core of the you don't need a blockchain for that argument. So just ignoring taproot assets for now, all stablecoins within it's funny, people will usually say like Ethereum and Solana, but most of the volume goes through Tron, which is a worthwhile point to pick apart, because I think the way I phrase it in the piece is something like Tron is pretending not to be a database the least. Right. And so, but because of that, it's the most effective for this, because you don't actually need a blockchain to do this. You just need a database. So, and actually maybe viewing that from kind of the other perspective, even more critical of the faux blockchain element, the blockchain component in all of this is basically irrelevant to how it functions, right? Nobody's using the blockchain as rails, right? They're not using it as payment rails. They're basically using it as an external public ledger, which is, they will often talk about that. Like, I'm sure this is a bit out of date now, but the meme of, digital ledger technology or distributed ledger technology. But they sort of gloss over that it's actually Tether's internal ledger that really matters. And so this is a key point in terms of like really nailing down why you don't need a blockchain, and that they don't give a shit about. Like, it's not the payment rails or anything. It's nothing about the tech of any particular blockchain that's relevant to how this works. Tether routinely burns tokens on one blockchain and reissues them on another. Like, for example, if one of them just goes down, which happens from time to time because they're bullshit in the first place, right? They're not remotely, maybe Ethereum you can kind of give it a bit of slack, but the rest of them are clearly centralized. They go down, people with Tether get pissed, Tether burns those units and reissues them somewhere else that's still live. The only relevance of these other entities is the external ledger that admittedly allows, I think, to give it a tiny bit of credit and sort of where the product market fit comes from, it allows faster transfers and more anonymous transfers because you don't have to constantly be liaising with Tether. But even that's a bit iffy. Like, my suspicion around this is it in sort of more fundamental technical terms, it may as well only be an internal database at Tether. It may as well just be Tether running the effectively eCash mint, right? Which is where the argument ends up going. But the reason they've done it this way, or at least the reason that it's succeeded this way, is a kind of regulatory arbitrage, in the sense of they've wowed regulators. I know the entire crypto industry has done this, obviously, but they've just confused regulators with buzzwords about how innovative this is and how decentralized and blah, 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 when in fact this could be shut down immediately. And which again is going back to, well, you don't need a blockchain for that. If you can just shut it down, then what's a blockchain achieving for you?
Yeah.
So,
well what it reminds me of, it's almost like, it just says that it's a blockchain, as you say. It's kind of like a buzzword that someone came up with over a coffee and didn't really think it through. And as you write about, I mean, RWA, real world asset tokens, have to have issuers. The value sits outside of the blockchain, unlike Bitcoin, where the unit itself is the value. And
exactly.
So this is, I mean, clearly a difference, right?
Yeah. So coming back to your question, though, in terms of the network effect, the implication of all of this, of not actually using a blockchain for, what blockchains are for, not really caring about the payment rails, being totally indifferent and just burning them and moving them somewhere else and so on, effectively just using it as an external ledger. It means that anybody who wants to get into this game of issuing stablecoins, which is something we should come back to because that's kind of why this is getting a lot more exciting now, they're like 8 years too late at this point, because the way anybody who will be using a stablecoin, so as opposed to the issuer of it, the way they're going to be thinking is precisely to this point of the real world asset conundrum, you are entirely trusting the issuer because there's no endogenous value in this, quote unquote, digital asset. It's another meme that's become popular around all of this. You both the sender and the receiver of a stablecoin are forced to trust the same issuer. And this is the crux of it, right? Because you might think that you might be bamboozled by all of the blockchain jargon into thinking there's some element of decentralization. Maybe not even so much in the, like, you get the fact that there has to be an issuer, but, well, why can't I, have my own issuer? And I can see a lot of the thinking here basically going towards how fiat banks actually work and how settlement between fiat banks actually works. But that's not at all how stablecoins work in crypto, precisely because of this element of, well, you're not using the blockchain to settle value. You're just using it as an external ledger that has to be matched to Tether's internal ledger. So both the sender and receiver have to trust the same issuer, because if they don't, there's simply no way to, like, it's not physically possible in terms of how these tokens on the blockchains work for you to trust USDC, me to trust USDT, and to somehow transact there. It just doesn't happen. So you have these completely segregated sort of ecosystems. I mean, obviously there are ways of making those trades, but not trustlessly. And hence that gets even funnier in terms of like reintroducing middlemen into this, right? And so one thing I wanted to come back to that you mentioned in terms of the breakdown of issuance, it's roughly Tether's 80%, USDC's like 19%, and then everybody else combined is 1%. It would just be 99, and then everybody else combined is 1, were it not for political interference. So USDC only really exists because the US federal government has told Tether that they can't operate in the US. But if that wasn't the case, Tether would be all of it, for exactly this reason, that any sender and receiver have to trust the same issuer because there's no settlement mechanism, because there's no relevance of blockchain in this whatsoever. And so that, I don't know if you want to get onto it right away, but that I think sets up nicely why taproot assets are different and ultimately why they're much better as well.
Wait, can you just confirm that for me? So you're saying Tether isn't able to operate in the United States?
Well, this is, at the time of speaking, this is a little bit up in the air.
Okay.
But historically, that hasn't been the case. Or at least, I think the way it's enforced is more like U.S. users and like service providers that are serving US users are not allowed to use Tether. And so it's kind of functionally barred from the US. That's probably going to change. I'm not politically connected enough to know exactly what's happening right now, but that's why USDC exists, basically.
Interesting. That would be probably a deep dive on its own, because that sounds like a bit of a...
I wouldn't be the person to do that.
Yeah, no, just separately. But yeah, that sounds like an interesting shenanigans going on. It's sort of like, well, Tether for thee, but not for me, or something. But, anyway, okay, so that's really interesting. So we've got this situation where you and me might just be using smoke signals to communicate, but at the end of the day, Tether is the one with the database telling us what's what. And maybe showing my ignorance a little bit, I haven't really used stablecoins that much. I've mucked around with Aqua Wallet, Liquid, Tether just a little bit. But I mean, maybe this is privilege, but I just, I'd rather use Sats or, something else. But
I don't know. I mean, I think that's perfectly reasonable. Because again, it's not crypto. It's just dollars.
I'll just use fucking wires
if you
or something.
Either don't need dollars or you actually have access to pretty well functioning dollars, then like why would you care?
Yeah.
But obviously for a lot of people they don't, and they do want this.
Yeah, so it's interesting. So we've got this situation where Tether is in this place, but again, because I haven't used it that much, and I'm showing my ignorance here, I'm curious because there's Tron, which, man, I don't even know like what that's supposed to be. But then you've got Ethereum and you've got these other chains, but you actually have to bridge between them, right? So if you kind of, the US, there's different kinds of Tether, as far as I understand. So you can't just sort of transact cleanly. It's sort of Tron to Tron. You can't go Tron to Ethereum Tether, is it?
It's a little murky there. I mean, you this is what I was referring to before in a slightly different sense with like USDC. There are quasi decentralized ways of doing this, but you are very much going down the bullshit crypto rabbit hole of, is it actually verifiable how this works. To what extent is there more blockchain jargon, pseudo innovation rhetoric powering it rather than anything that actually makes technical sense?
Yeah. Yeah. Well, one other thing, just I noted, you mentioned TVL, total value locked, and this is something I've heard.
Did I? When did I say that?
In the article, you say.
Oh, right. Okay.
Sorry, no, yeah, not now, but in the article you mentioned that, and this is interesting because I have heard people say this who are, I guess, more crypto people, and they're like, oh, TVL, this is how much is locked, blah blah blah. But I mean, as you identify, it doesn't mean anything because it's just a pass through. It could be anything. We could be,
exactly,
smoke signaling each other.
It doesn't really matter to anybody that it's like quote unquote on Tron.
Yeah, and
that could disappear tomorrow, and nobody would care.
Yeah, I mean, I think I would probably take a long look at it and think, man, I don't know if I want to use that. But most people don't care, and it's actually.
But it's important to let that like really sink in why that's the case, because this is why I was laboring this, what might have seemed sort of abstruse point about the internal and external ledgers. The only thing that matters is the internal ledger at Tether. The external ledgers are kind of nice insofar as they, facilitate easier transfers than might exist in fiat, which again is what the real competition is. Like, fiat dollars in a fiat bank are more difficult to send than stablecoins. That's basically the gist of the product market fit. But in terms of assuring, I don't know if that's even the right word, because there is quite a lot of trust in this. Like, it's not a technical argument. In terms of there being any widespread belief that the tokens ought to have value, right? That the peg should hold. You need to believe that Tether will redeem. And it doesn't matter what the blockchain says. Like, it's completely up to Tether, which means it's completely up to the state of their internal ledger. If they stop redeeming, then the entire enterprise falls apart, and it doesn't matter what tokens are issued on what blockchains, because that's the point at which everyone will realize they never cared about Tron or about Ethereum or whatever else.
Well, I think it's interesting as well, this idea of outsourcing to the public infrastructure of Tron, which is basically this shitty network that goes up and down, and these other networks where they have Tether available, but it's sort of those transaction fees are a part of it, right? And my understanding is Tron is the cheapest and shittiest, and so that's the one they sort of.
It depends what you mean by shitty. In some way, I'm going to make sure this isn't quoted out of context, but in some way it's the most honorable because it's just not like pretending. It's just like, we're a database, guys.
Yeah.
You want to use a database? Go for it.
Okay.
Which is why it's cheap, right? Like, this is like the core tension of bullshit crypto engineering, right? Is that if you're not, excluding Bitcoin, because Bitcoin actually is money, if you're trying to engineer it to be something other than money, the more decentralized it is, the more expensive it is, and hence the more pointless it is. But then in the other direction, the more centralized it is, the cheaper it is, but actually also the more pointless it is. So that you can't really win. No matter what direction you go in, you get some new dimension of pointlessness. Whereas Tron, I think, is almost the most open about, like, yeah, this is pretty pointless, but it kind of works for this one thing.
Yeah. Well, look, I mean, taking that idea then, the approach that's currently been used for stablecoins won't scale. I mean, do you have any kind of ideas of what those pains might look like?
Oh, it's just fees. It's exactly this point. It's that if you look at what seems to be pretty legitimate excitement in broader fintech, I brought this up 5-10 minutes ago. So the likes of Stripe buying Bridge for $1 billion and announcing, actually fairly recently, since I wrote the article, maybe 2 weeks ago or so. I'm not sure when this is going to come out, but they had some announcement about basically rolling out stablecoin capabilities for Stripe merchants. So, I mean, that's a pretty big signal of, like, a lot of money is going to be, or at least a lot of effort, let's say, is going to be put into this. And I don't have the exact numbers off the top of my head, but if you're just thinking about things like, looking at the actual volume going through stablecoins versus volumes just globally for payments, it's like many, many orders of magnitude higher. And if that moves to these crypto rails, they'll break. Like they just can't hold this. The fees will get so high that it completely undermines the purpose. And actually, it's good that we went through that example with Tron, because you'll end up in kind of a funny situation like that tension of how decentralized you want it to be will become a lot more obvious in everybody's minds, because you'll be saying on the one hand, so the more decentralized it is, so probably Ethereum is the best example of that. Actually, definitely Ethereum is the best example. The more decentralized, the more expensive it's necessarily going to be, and the less they can reasonably do about managing the fees. It's just going to happen. It's almost more Bitcoin-like in that sense. Like in Bitcoin, you really can't do anything about it at all, but that's a good thing. It's a security feature. In Ethereum, it's kind of a weird design bug because they keep claiming this stuff isn't money, so it shouldn't matter. But the fees are just going to make it unusable, at which point they'll look elsewhere. So they might look at some like bullshit layer 2, I said layer 2 on Ethereum, which is really just completely controlled. Or they might just go to some other blockchain, so they might go to Tron. They're actually, I would argue, just different versions of the same thing, because what you're doing there is just moving into a more centralized environment where fees can be directly managed because you don't have the baggage of the fake decentralization. And I think all of the bullshit, that's why I'm calling them bullshit layer 2s on Ethereum, are essentially making the same trade-offs as if you just went to Tron. But the more you do this, the more it kind of hits you that we really don't need a blockchain for this at all. So this is the progression I imagine the likes of Stripe going through. They tried on Ethereum, fees go insane, completely undermine the entire proposition. Then they move to either Tron or some bullshit layer 2. It gets better, but they recognize, they surely have to recognize at some point, maybe just because there's some issue of like censorship or some other downside of it being woefully insufficiently decentralized. Maybe it's actually exactly back to this point about they still are forced to use Tether in this setup because like nobody else can reasonably issue because of that network effect that was lost 8 years ago now. They're gonna have to recognize that once again, it's really only Tether's internal ledger that matters here. Like if we're already trusting that database, why are we using this basically just a database? Like, because that's what Tron again is basically just a database. Bullshit Ethereum layer 2s basically just databases. Why even bother trusting them if you already have to trust Tether and there's no way of introducing any value settlement because blockchains don't matter? Like they're going to go through all of this. Everything that Bitcoiners grappled with, I think in, somewhere between 2016 and 2021, Stripe is going to grapple with between 2025 and 2031.
So we can sort of maybe hypothesize there's this future where, Wise or Revolut, is the experience we get. And we maybe have to even submit some ID. We've got a KYC to use the database for Tether too. It sort of becomes, it's not centralized in any sense. And
that's a good point, actually. Yeah. That's when you were saying that, I was a little bit skeptical because I do want to try to, I guess, steelman all of this the best I can. I don't just want to make fun of it because I think that's, well, I mean, I do want to make fun of it, but it's more powerful if you're like actually, being technically accurate in picking it apart. The KYC thing, I think, is more a decision of any apps that decide to use the tech. But you do make a very good point, though, because it dawned on me quite quickly that the more centralized the, quote unquote, like underlying tech gets, the more the apps that are connecting to it are kind of indistinguishable from that layer and can in fact just force you to use it. Like it could well be that there actually isn't a way to use Tether without KYC. Whereas, and this is back to that tension, right? That the more decentralized or like fake decentralized the technical environment it's in, you do at least retain that optionality, but also it will break. So they'll stop using it and they'll move somewhere more centralized. So there's just no way around this, basically.
Well, I mean, so taking that argument, to its extreme, I do think there could be a reality where, sanctions, OFAC, whatever, mean that, and it's one company, they can just come in and say, no, this, you have to just KYC the peeps, and then that's it, and then
that's kind of what I meant by censorship, by the way. I didn't really tease it out that much, but again, the more you embrace that, or kind of, it's not really embracing, it's like reluctantly accept that trade-off that the fake decentralization makes it unworkable, so you move into a centralized environment, so suddenly everything can be censored and you're completely undermining. Like it's just back to, there's nowhere on this spectrum that isn't dumb for some reason, or was it pointless? I think I called it before. That isn't pointless in some dimension, and I fully expect Stripe and Wise and Revolut to explore everywhere on the spectrum, cover every single every single point of pointlessness, and eventually in like 2035 or something realize that we're right about this.
Yeah. So like, I think that, in short, that reality is going to continue on potentially where that, it centralizes more and it basically just becomes, Wise with Tether qualities basically. And, maybe that's actually an okay experience for people who, in shit countries or whatever, but it's still going to be losing its value and all these inflationary issues.
Do you know what's interesting about all this though? So this then sets up the contrast to how it would work with taproot assets really nicely. This entire conversation, we've just taken for granted that Tether won't rug you, right? But like, will Wise rug you? Will Revolut rug you? I mean, you could argue like probably not, but again, you can see even just in that sentiment alone, I think you see the pretty stark contrast between this and Bitcoin. So stark that I again would argue this isn't even crypto. We're not talking about crypto. We're talking about fintech rails. People don't think that about fintech rails. Like regular people just don't think, will I be rugged by Revolut? Right? I mean, you could argue maybe they should, but they don't. And it's quite a different attitude that you need to have that in some sense is just forced on you by how it even works in the first place. So Tether could rug you. Like that's
so no, but what it would be though is it'll be the trade-off where you got a KYC and it goes through its Wild West phase and then it becomes KYC'd and then it becomes backed by the government and there's these backstops and I mean basically it is fiat and it continues to be fiat like but I do want to move into the taproot assets and the Bitcoin side because this is of course moving in parallel to all of this. And I mean, to be fair, I mean, I've looked into taproot assets a little bit. I mean, I haven't really used them that much, or I haven't used them at all. I'm not really too familiar with the exact workings of it. But you're seeing this, I mean, obviously Lightning Labs has made this announcement that they're working on it. I don't think it's launched yet though, is it? The Tether?
As far as I'm aware, Tether hasn't, but there are some stablecoins as taproot assets out there.
Okay. Tell me more about this in terms of like what does the taproot assets mean and sort of how does that contrast with everything we've talked about up until now?
Yeah, I mean, I probably am not the best person to give like a technical deep dive on this. I'll describe it at a fairly high level that I think is more relevant to, in as much detail as I think is needed to fit with the rest of what we've been talking about.
Yeah.
Which is basically that a taproot asset is it's really an asset issuance scheme on layer 1 Bitcoin. It's a way of basically making Bitcoin transaction, but imbuing it with all this metadata that everybody else who is on board with this protocol is like, oh, okay, so that's what this asset means, and you can track it and so on. It very much in the vein of I forget the number, but was it ERC20? I think is the one for doing the same thing on Ethereum. That wouldn't be that interesting were it not for the fact that you can, so once these assets have been issued, you can open Lightning channels denominated in them, and you can route them over the Lightning network, even though only the first and last hop need to be in this non-Bitcoin asset. So you can make an atomic payment across Lightning, the middle X hops of which just are Bitcoin payments in Lightning. I think that's basically all you need to know to fit it into everything else that we've been talking about. So my thesis on this, when it was first publicly announced, just as an idea, like this was probably 3 years ago or something now, there was a lot of hype around things other than stablecoins. Basically, I don't really want to go too much into it, but I'm mentioning it just to make the point that I think this only works for stablecoins. I don't really see anything else that I think taproot assets even can be used for. The reason basically being that I don't think there's anything else that has anywhere near enough value for the mechanics of this transfer to work, in the sense that dollars, and I guess probably all fiat, kind of has uncapped value. Well, sorry, I shouldn't say value, like nominal value, right? In the sense that there's no maximum to the number of dollars there could be, and so long as the incentives are right for people to use this, people will always put more dollars into it, as opposed to like basically any other kind of, real world asset thing like a tokenized security or something. Even if you, like, the biggest company, I don't know what the biggest company in the world is right now, probably Apple or Google or somebody like that. Even there, it's questionable that there would be enough value denominated in Apple stock, that not in absolute terms, but that people would be willing to put into this protocol to actually enable routing. And then even on top of that, like, it's not clear why you would ever want to pay for anything with Apple stock. Like, that doesn't really add up. So in my mind, this is a good shortcut for your listeners. I mean, do your own research, obviously, but my take on this is taproot assets are for stablecoins. I don't really think they're going to be used for anything else. So kind of now injecting that into all the other arguments that we've been making, you see two very crucial differences here to how it works in crypto. So one is that this time you actually are using the blockchain for something that you need a blockchain for, right? You're using Bitcoin and Lightning specifically for value transfer. And you could maybe call it settlement. I think that's kind of muddying the waters a little bit, but that is actually what it's for. And you notice that you can't just like burn all the tokens and go somewhere else and do this, because you do in fact lose the rails, right? This is the key difference, I think, to like Tron versus Ethereum. You can just burn a whole bunch of Tether on Tron and reissue it on Ethereum, because nobody actually really cares how Tron or Ethereum works other than it being public. Like, the fact that it's public and the fact that you can send it, that's kind of all you care about. Again, could just be a database. The taproot assets construct couldn't just be a database, because you need Lightning for it to make any technical sense. Like, the way the value is transferred is atomically through Lightning. So that's one difference, is that it's way less stupid in terms of why you're using a blockchain for this. The second one, though, this is why I was glad that we spent a bit of time on the point about Tether having the network effect, is that I don't know if this will be immediately obvious to the audience, but I think we've covered enough grounds for them to at least go away and think about it, that you don't need the sender and the receiver to be using the same issuer anymore. So this massive unreachable network effect is now gone, in the sense that, it could be, I don't know, well, let's use examples we've already come up with. Actually, it could be like Revolut. Like, I have my Revolut stablecoin on Lightning, and I want to pay you, but you don't have a Revolut account, you have a Wise account, right? And they also have their own stablecoin. This is completely trivial to do in taproot assets, because basically I send my stablecoin goes to, whether it's directly to Revolut, or it's, I have a channel with a market maker, however it ends up working. So it goes, dollar, like Revolut dollar, Bitcoin, and then Wise dollar comes out the other end. And what's actually even cooler here is these banks, basically, is what they are, stablecoin issuers, but they're effectively just banks. They don't even need to trust each other. Like, they don't need to know each other even at all. Everybody's just relying on the fact that Lightning is real, right? Lightning is like a real functional thing that effectively sends value and can imbue the value transfers with various cryptographic properties that enable this entire transfer to be atomic, such that there's an interesting level of trust involved here, in that obviously you can't avoid trusting the issuer of the asset, but you don't need to trust anybody else in any of this. And again, even there, that's completely unlike, you're asking the questions about, can you swap from USDT to USDC? Like, kind of, it's a bit unclear exactly to what extent, who you're trusting and why, and what the fees are, blah, 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 blah. And then even, like going in and out of bullshit layer twos and that kind of thing. Here, it's kind of assumes you already have trust in the issuer if you're using a stablecoin. I actually would just encourage using the terminology bank at this point. Like, you trust your bank. You don't need to trust anything else about how this works, because Lightning is great, basically. So I guess maybe there is a third point that's worth mentioning quickly, that this is what I meant by it's the most difficult when it starts, just because of probably inadequate liquidity, and like the size of the Lightning network is minuscule compared to the amounts that are transferred in stablecoins already elsewhere. So significantly more value needs to come to Lightning to enable this. So it'll be the most difficult, by which I basically just mean it's like it will be costly to issue you won't always, it'll be like the early days of Lightning, basically, that you won't always be able to find a payment route. It'll be kind of clunky for a while, probably. But that in and of itself creates opportunities for people to make a profit by enabling it more effectively. So in theory, you can imagine it will start to, as soon as it works really at all, it'll start to attract more and more value. And then the bigger it gets, actually the cheaper it will get. So that's completely flipped from in crypto, because as we covered, right, in crypto it's just the gas problem, because you shouldn't really be using a database in the first place. Oh, sorry, you should be using a database. You shouldn't be using a blockchain. Here, you should be using a blockchain because you're sending value, and that's what it's for. So that's
just to confirm that. So you're saying those middle hops, though, those are just bog standard Lightning routing nodes. So there's actually a couple of other things here that are probably worth pointing out. Number one, there's going to be fees involved in there, which over time actually incentivizes routing. Yeah. And then number two, as you say, starting off, it maybe needs to scale more just to get the volume and the channel sizes to go up. But that's got a stickiness to it, I think, where the average channel size is just sort of slowly creeping up. But that's kind of like, I think of that like hardwood, it's like the oak tree that's growing and sort of building those channels and those relationships between the nodes. That's kind of hard. You pay for that up front, but unlike the running it on a shitcoin, it's not going to fall over when it actually needs to run. So that's a really interesting sort of scaling thing to consider. And ultimately with Lightning, being able to run it through these intermediate nodes, it's a win for everyone who's just using Lightning, normally, I guess, as well. Yeah.
So that's the point. I alluded to this right at the start and then sort of dropped it, but that is a reason I think Bitcoiners could be excited by this, even if you really don't care about stablecoins at all. That I see it all as kind of a Trojan horse to just, what would be the right word, like Bitcoinize fiat in the first place. That this is, if it kind of go back through everything that we've covered. So this design is clearly superior, in my mind at least, is clearly superior to how it works in crypto, with the minor caveat that it's going to suck at the beginning, but the more it scales, the better it's going to get. So if it can be effectively bootstrapped, then we're scot-free, right? So clearly better than crypto. In a lot of cases, crypto is clearly better than fiat. Annoying as that is, it just is true. And so, but then the added component, which is like, you could have an ideological spin on this if you wanted, I suppose. Equally, I think I covered this earlier, though. You can think of this purely practically too, that the Bitcoin monetary system is kind of, I want to say physically, I don't know if that's exactly the most helpful way of describing it, but it's segregated from fiat, right? It's they work in separate ways, and you can manually switch from one to the other, but it's a hassle. With all of that in mind, even if you don't care about, even like fiat, say, like you don't care about fiat, you definitely don't care about stablecoins, you should, I think, be at least mildly positive about this, because it's going to make it so much easier. Like, if this all works, right, it'll be a while away. It's going to be like 10 years in the future or something, maybe even longer. At that point, it will be so much easier to orange pill people than otherwise, because it won't be a question of basically everything that we're used to now in terms of how much of a practical nuisance it is. I mentioned this earlier, right? It'll literally just be flick a switch. Like, do you want to just stop accepting this government shitcoin and accept Bitcoin instead? It's like, cool, we'll press that button and it'll start happening like now.
Yeah. Could you tell me, please, so with, Tether have these magical, T-bills somewhere, and they're using Tron to match that on a database somewhere, but how do they're burning and issuing to keep the peg, and that's a process that they're running.
It's not to keep the peg, it's purely for operational purposes. Like the peg is kept by trust, by their effective operation. They're basically, there's something I mentioned right at the start actually that we didn't cover that is worth going into a little bit of detail on too. I think the best way to think of Tether in kind of economic terms is just as a fully reserved bank, right? And I kind of alluded to this before when I was saying that, especially in the Taproot asset setup, I think the language is a lot cleaner if you like stablecoin issuer to me is weird. It's a very crypto centric thing because people didn't know what else to call it. And I get like why it's it's straightforward enough English, but just calling it a bank I think makes more sense. So Tether is a fully reserved bank that you by definition, or to the extent you believe that definition, you can't run it, right? You can't run Tether in the way that you can run literally any fiat bank by just pulling out your deposits because there's no leverage there. So that's basically all Tether is. And again, even this goes to it kind of, I think, at least a little bit helpfully explicates the point about the internal versus the external database. The burning and issuing of tokens on whatever other blockchain is completely irrelevant to the actual economic workings of Tether. The economic workings of Tether are people send them dollars and they buy treasuries. That's it. That's literally it. There's obviously all the token issuance stuff is like why they're sending them dollars because they want to play around with the tokens over here, but it doesn't matter at all. It's like could be anything. It could be a database again.
Yeah. So sorry, excuse my ignorance here, but so when it comes to the taproot asset side, these Lightning channels, sats will be flowing through there, but those sats, and it's not necessarily going to equate to a dollar value. Is that like how does that work? Like like what does one sat mean going through a Lightning node and then coming out the other end, or is that just the information?
Oh, I see. Yeah, I was kind of dancing around this. I'm not sure this is worth going into that much detail on in terms of like an economic view of all of this, but in a taproot asset channel, the denomination is, I mean, dollars basically, right? It's denominated in whatever that taproot asset is. Like, it effectively has its own. It's kind of hard to describe because it is still pegged to a specific UTXO, but you can almost think of it as like, how, I don't know if this is a helpful metaphor. I'm just coming up with this right now, and I might regret it. How equities have par values, which is typically like 1p. Or $1 or something like that, because there needs to be, for accounting purposes, there needs to be some capital contributed to explain the liability. You can think of it kind of like that, in that, in a technical sense, yes, this is pegged to the UTXO in which it was issued, but there's no Bitcoin value there, and hence it's exactly as it's trust in the issuer as to why anybody would think it has any value.
Okay, so we're still on.
The key thing is that you can route atomically across Lightning. So you can have the first hop be your dollar payment, then every other hop will be an equivalent dollar value of Bitcoin moving until the very end it swaps back into some other dollar denominated taproot asset.
Oh, I think I'm beginning to understand. So you have the Wise and Revolut at both ends, and the first hop, it's sort of, maybe it's doing its own thing, but then from that point on, there's, I guess, in its instance, it'll be spot price, right? The value in sats would match the value of the dollar.
Yeah.
Is it? Yeah. And then it would kind of come out the other end and be ingested.
I mean, just to be clear, this is very much getting into the details that are, I don't think really matter for for understanding the economics of it, but there's a bit of negotiation involved in the sense that you need people. There's some terminology your audience might recognize. I don't know to what extent this has even been kind of settled on, but people talk about like edge nodes and dexes, so like decentralized exchanges. I think I said market makers before, which is more like TradFi language, but it's pretty like uncontroversially what's happening. There's almost certainly this will be automated, right? It's not like somebody's gonna, like an actual person is gonna be sitting there deciding what they think a good value is, but you do, as part of arranging the atomic Lightning payment, both sides need to agree on what the effectively exchange rate is at the first hop, and then what the exchange rate is going to be at the last hop. And the thinking, this actually goes back to the point about, I think I brought this up, but then you mentioned it even in more detail, that you can imagine there being a profit opportunity here that attracts more liquidity in the first place. Like, obviously there will be, there's fees throughout because it's a Lightning payment, right? Every routing node is going to take a fee. There's there's definitely going to be a minuscule profit to be made on that exchange, which is like an FX swap, basically, which is what, in theory, attracts liquidity in the first place for people looking to profit from these trades.
Yeah, no, that's fascinating, and I mean, it is a technical detail, but it sort of clarified in my mind just that there will be sats that are somewhat resembling the real world value of that dollar, sort of flowing through the network.
Oh yeah, yeah, yeah.
And that's good
Which
to
is
know.
key. Like that. Sorry, that is worth emphasizing. That component of how it works. I completely agree, because that's the crux of what I was saying in a much more like almost rhetorical context before, as like you do actually need a blockchain for this.
Yeah.
Right? You see what I mean now, that you can't just copy and paste this out of Lightning and try to do it in Tron, because there is no such mechanism in Tron, because Tron's not money.
Yeah. A couple of other things, man. So there's Liquid have got this, have got Tether, and I'm just wondering what your thoughts are on that. Is that sort of a middle ground where it's a federated
Yeah, I've always
system?
thought of it as being kind of a middle ground. I don't want to get too distracted by this. I have talked about this publicly previously before, but I have a very specific view of what I think Liquid should be for, that I think very few people agree with me on, or at least very few people are as specific and as public as I have been about this. And I think Blockstream's marketing around it hasn't really helped. And just to be clear, I say this as a Blockstream board member. Like I'm pretty openly critical about this. For what it's worth, I think Adam Back is one of the few people who does agree with me. But this is more of a historical issue in terms of how Liquid came about in the first place. What I think Liquid should be for is security tokens, basically. I think it's perfectly designed for that, and not really well designed for much else. I think almost every other use case that has historically been attached to it is like fine if people like it, but it's just not great design. This is actually kind of a similar criticism, by the way, to stablecoins on crypto. Now I think about it, is like, I guess it's fine. Like if you like it, that's fine, good for you, but it's not very well designed. I think Liquid's for securities tokens, which is completely. I mean, we can talk about that if you want, but I think it's a completely separate discussion to this.
No, cool. I just wanted to highlight that, and then the other thing I just wanted to throw in the mix here while we're talking about stable coins is: have you encountered the concept of stable sats?
Yes.
And I mean, just from what we've talked about, I mean, my take, and then I'd love to hear what you think, is that almost that FX maker role. Someone like Galloy and the stable sat system they've got. I mean, it feels like that would be a perfect integration there with our sort of having.
That's interesting, actually. I don't know if I have anything sensible to say about that, because I've never thought about it before. The reason I've always been a little bit skeptical, like I think it's kind of technically cool, but it's very trusted. It's as far as I'm aware. There's no real way to use, because there's no like Oracle or anything. There's no price feed. You really are trusting your channel partner to be honest. And I know that it's usually proposed in a way that they're very strongly incentivized to be honest. I'm just not sure. I need to think about it. I don't know how it would integrate with this, if at all.
No, that's fine. I mean, I get my understanding, and maybe my information's out of date, but with something like the Blink wallet, which is a custodial Lightning system, right, you can have stable sats in there, and they are the bank, and they are managing that peg for you, and are hedging on both sides of that to keep the value. And in El Salvador, whatever, people are choosing to move their Bitcoin into that stable sats to keep the dollar value. And I'm thinking kind of in this situation that they're kind of in their own universe at the moment, but you could have Blink doing that over here, and then another system doing it on the other side, and then that actually.
Oh, that's a good point. Yeah. You could totally have that. So you're saying you could have like, I have my Revolut dollar as a taproot asset, and I want to pay somebody using Blink who actually just has a stable channel. That would totally work. That'd be fine.
So there's some interesting stuff there.
Which,
and I think
even that is cool, by the way. Like that's maybe an even better example. So when I gave the example before, I was like, oh, you don't need to all trust Tether anymore. I can trust Revolut. You can trust Wise. You can push it way further than that. Like you could trust, or trust is exactly the right word, but you could be using something that has its entirely own, isn't even taproot assets, right? It's some completely separate design. The only real requirement is that it uses Lightning, or even you can push it even further than that. Now I think about it, it needs to be able to use Lightning. It doesn't like have to be Lightning centric necessarily. So that's cool.
Yeah, no, so there's a lot of really interesting stuff.
Actually, sorry, I've just come up with a good one, right? So This is linking back to something you mentioned. You could I hope this is correct. I'm just thinking of this right now. Um, you could have a Lightning, you could have a Taproot asset Lightning payment that starts with me sending a Revolut dollar, goes Lightning, 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 and then does a Bolt swap such that you receive Tether on Liquid. I'm nearly certain that that would work and would be fine.
Yeah.
And again, you need Lightning for this. You
Yeah.
can't pick this up and plop it into crypto. It won't work.
Yeah, and I mean, I've said many times, I mean, Lightning is its own miracle. I mean, just the way that works. Lightning and Bitcoin together, wow. But Lightning on its own is pretty awesome as well. So there's a lot of stuff there, Alan. I guess one other thing just maybe we could wrap up on. You wrote a little bit about the history of Visa.
Yeah.
And I thought maybe we could just sort of dwell on that for a moment because it really
that's one of the coolest parts of all of this, I think.
Tell me about that, yeah.
So... again, I'm wary of speaking for like 30 minutes. So the way Visa came about in the first place, I think, this is kind of a spoiler, I guess, but I think in hindsight wasn't possible without Bitcoin. Like the original goal of Visa couldn't be achieved without effectively Taproot assets. It's like, that's the spoiler. So originally, Visa was a not-for-profit. It was a cooperative between member banks. And the goal was to... they did want what we now know as Visa, right? For basically for credit cards. Well, actually, even that's interesting. Sorry, that's not true. The original goal was not for credit cards. The goal was for debit cards, which obviously that is still a thing. But the reason we've ended up with credit cards is quite interesting. And the reason that Visa has ended up as a for-profit like kind of oligopoly with MasterCard is also very interesting. And it basically comes down to within fiat, other than basically central banking, which is kind of missing the point a little bit, there is no way to send a debit. Like it's literally impossible to send a debit because all fiat money is commercial bank liabilities. And the only way that you can transfer between commercial banks is by them taking credit risk with each other to update their balances. And there may even be, it depends exactly how removed they are from one another. There may be even more like middlemen and even more risks and delay and potentially FX in there as well that makes it even more complicated. Prior to, I wouldn't even say credit, Visa, I guess, the card networks, let's say, prior to card rails, the only way of making such a transfer was via central banks. This is actually why a lot of this, contrary to like Bitcoin lore, this was the express purpose of the creation of a lot of central banks, more historically recent ones, to enable, I guess, free, it's obviously not really free, but like nominally free interbank clearing. However, that was only ever available to banks. It was never available to customers. So D Hawk, who's the founder of Visa, his original concept with Visa was effectively interbank clearing extended to customers such that people can pay basically not with checks. Like that was kind of his idea, like not with cash, not with checks, digitally, instantly. And so original idea idea for the entity rather than for the the product as such, cooperative between member banks, and basically it just gets gradually corrupted because first of all they realize there needs to be a credit component to this because you literally can't send a fiat debit. It doesn't exist. That's where credit cards come from. And eventually they just, this is maybe not so much a fiat thing as just like a human nature thing or whatever, but they realize that this is incredibly valuable. They eventually shift it into a for-profit. Then they list it. It goes public at some point as well. And now it's, as I mentioned, it's just like a gatekeeper effectively. But if you read, so I actually might have the book around here. No, I think I moved it. Highly recommend everybody read D Hawk's book. It's called One from Many. There's also another one I recommend in the piece, which I think is a good counterpart to it because the One from Many's like, it's kind of funny how it's a little bit over the top in places. It's very personal. It's almost like it's more a biography of him. It's like a professional biography, and you can tell he's very passionate about it, and he's very angry at how it went completely off course. I think the other book is called Electronic Value Exchange. I think that's the name of it, by David Stearns, which is more of like a historical, like purely kind of dry historical account of the same thing. If people are interested in all this, very much recommend both of those books. They make a good pairing as well, just because of the different, like they're talking about the same things, but with a different perspective on it. The reason I mention that though is so in One for Many in particular, D Hawk is very insistent on what his original vision was, and very annoyed at how corrupted it became. And so basically my take is this was completely inevitable in fiat. You actually need Bitcoin, and I guess now we also know you need Lightning. You maybe also, but even on top of that, you maybe need taproot assets for this to work the way he intended for it to work, which is I forget the exact quote that I give in the piece, but it's something like open, permissionless digital value transfer mechanism that anybody can just plug into and use. You can't do that with fiat, but you can do it with Bitcoin. And so the final step in all of this is that, again, going back to this point about Tether has this amazing network effect that will probably never be overcome. But if we move into if stablecoin issuance becomes predominantly on taproot assets, you don't have that network effect, and conceivably anybody can issue a stablecoin. It really just comes down to how well reserved are they, how trusted are they, some probably relatively minor technical points about how well connected to the network they are, blah blah blah. You're basically rebuilding Visa at that point, but with the interchange element not being a company that, per these books ends up being corrupted because it's kind of unavoidably for profit. The interchange component just is the Lightning network, which kind of obviously can't be corrupted in that way. It's a significantly better design to meet this goal, which I think is pretty cool. So if we then get a whole host of this would again be like way far in the future, probably 10, 20 years, something like that. But if you have hundreds, thousands of taproot asset stablecoin issuers, potentially in different currencies as well, because that's a key part of like the value add of Visa, and they're all just settling through Lightning, that is the original vision of Visa, not at all what Visa is now.
Yeah, that's profound, and I think the idea of the global Visa, let's go anywhere, let's you do what you need to do. I mean, having that compressed down into actually the network itself. I mean, it's pretty
cool.
Pretty awesome. One other thing, I'm just conscious of time, we haven't touched on this too much, but you do write a little bit about eCash, and we both know eCash also kind of needs Bitcoin to work as per David Chalmers' original vision. So do you have any comments just on how eCash fits into this vision as well?
Well, this is way more speculative, I think, than most of what else I've talked about. And it's really just, the idea is to come full circle on whether or not you need a blockchain for any of this. And I don't think it's realistic to jump straight to stablecoins being issued as eCash. So the thinking there is you're just being completely honest with yourself. You're like, the internal ledger is the only thing that matters. The external ledger is like kind of a LARP, but it's at least better than fiat. But actually, if we use an internal ledger as Xiaomi and eCash, the first step, if we use it as Xiaomi and eCash, it has vastly better monetary properties, primarily around privacy. If we go further and then integrate it with Lightning, which is basically a default of the Cashew protocol, it assumes that you're running a mint on top of a Lightning node. Then you get this far greater connectivity, and you can kind of emulate what we've been talking about with taproot assets, in the sense that it's baked into Cashew, and I think it probably will be for if anybody else tries to do some eCash protocol that has anything to do with Bitcoin. This it's sort of obvious that you would want this to be the case. It's baked in that somebody can send their. Also, keep in mind, sorry, clarification, that the main assumption with Cashew is that the eCash is denominated in Bitcoin, so that it's a bit kind of more ideologically pure, but it doesn't have to be, right? It's basically just a variable that you can configure. You're like, new asset called this, whatever. But the assumption is you can pay, like Alice can pay Bob, or Alan can pay Cody, and it's the payment flow is me to the mint to mint over Lightning, and potentially with many other hops in between. and then pay out mint to Cody, which is very similar to what we've been talking about with taproot assets. It's almost more like it's kind of more from the ground up, which is sort of nice ideologically, I guess, but I don't think it's all that realistic that it'll take off with stablecoins that way. I think you do need this this is really much more of like a commercial point. Tether's not going to start issuing eCash, I don't think. I don't think that's really realistic, but they are going to start issuing taproot assets. We know that they've said that. So with all of that in mind, the far more speculative idea is taproot assets can be kind of an on-ramp for stablecoins and just, fiat in general, right? This is how we Bitcoinize fiat. We get them into Lightning with taproot assets. Once it's all there, though, and once it's no longer really needed as like a way to suck value from crypto, my thought is you may as well just come full circle on being honest about the database, and at that point, just swap it out. Just like the rails will still work exactly the same way because the rails are Lightning. Like that doesn't matter. You get vastly greater privacy, and there's benefits for the issuer as well. It's not just it's cheaper basically is what it amounts to. Better privacy for the user, much cheaper. And it's kind of this, even that, sorry, is worth lingering on. It's cheaper because you don't need a blockchain, right? So that's kind of the gist of why it ends up being cheaper for them too. And the only thing that you really need to make this work is you still want the payments to be atomic. So you need the eCash to be capable of being hash locked, which is all you need to then integrate it with the rest of Lightning, which it can. So this is another primitive within Cashew and will have to be for any alternative eCash implementation. And so that's kind of thinking is like once you have all these pieces in place, you may as well take the final step and just admit that you don't need a blockchain for this. Just have the internal database. Just make it like the coolest, most powerful internal database that we know about anyway, which happens to be Chimene eCash, and then be done with crypto for good.
Yeah, that's incredible. And I think, my thoughts on that. I think we can think about the technology of it, but there is that social component, and it might be a case of sort of you go forward a step and you sort of linger there, you let that kind of deepen, and then you move on to the next step. And there's this
because it would be way better socially to just start using eCash right now. Like if Tether, you could even think about this like counterfactually, if Tether had always issued eCash, like they never bothered with crypto at all, it's just eCash, like that would have been better. But it probably also wouldn't really have worked the same way. Yeah.
No, that's cool, man. So I think that's it's covered sort of the article. I do recommend people go and check that out. And it's titled a half-baked thesis on stablecoins. But I think it's pretty comprehensive as far as I can see.
No, I'm honestly, I think it is pretty half-baked. I'll tell you why. So
okay.
I meant to mention this in the introduction actually, but we just went straight into the meat of it. That I say this in the first few paragraphs, right? But that I've been thinking about all this stuff on and off for like 3 years, probably since the Taproot Assets announcement, which I think was in 22, but just never really had that much of an impetus to go further with it. I think in part too because you mentioned in the we didn't cover it all in terms of what we talked about, but my like day job is Bitcoin VC, and just because of the stage of the project. Hadn't ever, like I see Lightning stuff all the time, as I'm sure you can imagine. Probably almost everything that we look at has at least some Lightning component to it, but there hadn't really been anything Taproot asset centric, which is not that I would expect there to. I think I do expect it for the next couple of years. I think it'll be really exciting to see what pops up. But yeah, so I didn't have that much of an impetus to like actually write any of this down or form a coherent thesis around it until the Tether announcement. And then I was like, holy shit, this is like actually happening. This is a thing. I need to think about this. And the piece, I wrote it in 1 4.5 hour sitting because I had a train journey from Edinburgh to London. I didn't have anything better to do. So I was like, this is my chance to just get all of this out and see if it makes any sense. I think it's like relatively half-baked just in the sense that I said this a couple of times in this chat. Hopefully it comes across as relatively sincere. That is very speculative, right? This is not at all. This is what is going to happen. It's just I think if people now want to go read it, I would do so in the spirit of this might happen. Like, here's what I think the incentives are now, or like, here's how I think the incentives are changing. Therefore, I think we can be hopeful about the direction this is going. But I don't really know. I'm not claiming to know.
Yeah. Well, I mean, for me, it was a provocation, and certainly, I mean, I understand what it's like. You sit down and you just got to get it out of your system, and it's it comes through. And I think now, I mean, we've had this conversation. I mean, others are having these conversations, and I think putting it out there and having at least the conversation is sort of maybe for people who, even just the connection with stable sats and some of the stuff we talked about today. It's like, oh, actually, there are some connections coming through, and they're all connected by Lightning. It's pretty amazing. So, I mean, I think there's some cool stuff there, man. But look, wrapping up, what's next for you? You got sort of, I don't know, in the next little while, you got sort of things on your horizon. What's up with you?
Nothing all that exciting, to be honest. I mean, I'm off to Oslo for the Freedom Forum next week. I then actually don't travel all that much for a while because I got a pretty full slate in autumn. So I'm going to be, at least I hope I'm going to be, I intend to be at Riga. There's two BTC++ in Europe. So one in Istanbul, then one in Berlin, and then I'll be in Lugano at the end of October. So I'm kind of saving my energy for that long haul.
It's Tethertown, isn't it, Lugano?
Yeah. Tetherfest.
The Tetherfest. Okay.
That's an unofficial title of Lugano Plan B.
No, that sounds cool.
TetherCon.
TetherCon, yeah, the great con. All right, man. Well, look, that's pretty awesome. I mean, again, thank you for sharing your thoughts on this, and I hope we can, keep the conversation going, because this is really interesting stuff, man. And I think when we look at all,
I've had a great time.
Yeah, all of this stuff happening. But look, man, I'll leave you to it, and otherwise, thank you for your time.
Thank you.